Today, the global economy is going through one of the most critical transition periods of the last 20 to 30 years. A system that expanded for years under low interest rates, abundant liquidity, and accelerating globalization is now facing tighter monetary policies and increasing geopolitical uncertainty. After the 2008 global financial crisis, central banks adopted expansionary monetary policies to keep economies afloat. Interest rates remained low for an extended period. Large amounts of liquidity were injected into financial markets. This environment pushed asset prices higher, made borrowing easier, and increased global risk appetite. However, the balance shifted during the pandemic. Governments introduced massive fiscal stimulus packages to support households and businesses. Money supply expanded rapidly. At the same time, production and global supply chains were disrupted. Demand recovered faster than supply. As a result, global inflation surged. As inflation became more persistent, central banks were forced to change course. At the center of this shift was the Federal Reserve. As inflation accelerated in the United States, the Fed began an aggressive interest rate hiking cycle. These decisions did not only affect the U.S. economy, because the dollar holds the position of the world's primary reserve currency. A significant portion of global trade is conducted in dollars. Energy commodities and many financial transactions are priced in dollars. Central bank reserves around the world still hold a substantial share in dollar-denominated assets. When the Fed raises interest rates, two major consequences follow. First, the dollar tends to appreciate. Higher interest rates attract global capital seeking better returns. Investors move funds toward dollar-denominated assets, increasing demand for the currency. Second, pressure builds on emerging markets. Many developing economies carry a considerable amount of debt denominated in dollars. When the dollar strengthens, their debt servicing costs rise. This increases financial vulnerability and can strain local currencies. Capital flows also shift in such an environment. Funds often move away from riskier markets toward perceived safe havens. U.S. Treasury bonds, in particular, become attractive during periods of uncertainty and higher yields. On the European side, the European Central Bank also responded to inflation with rate hikes. However, the structure of the European Union differs from that of the United States. Europe is more dependent on external energy sources. Following the Russia-Ukraine war, rising energy costs place significant pressure on production and industrial output across the region. This environment contributed to periods of weakness in the euro. The euro-dollar exchange rate is heavily influenced by interest rate differentials and growth expectations. When the U.S. economy appears more resilient, the dollar strengthens. When growth prospects in Europe weaken, the euro tends to come under pressure. Turning to gold, its role in the global economy remains distinct. Gold has historically been viewed as a hedge against inflation and uncertainty. However, in modern financial markets, gold prices are closely linked not only to crisis expectations, but also to real interest rates. Real interest rates are calculated by subtracting inflation from nominal interest rates. When real rates are positive and elevated, gold often faces downward pressure because it does not generate yield. Investors may prefer interest-bearing assets in such an environment. However, during periods of geopolitical tension, financial instability, or declining trust in monetary systems, demand for gold can increase. In recent years, Several central banks have expanded the share of gold in their reserves. This trend can be interpreted as a sign of caution within the global financial system. Currently, three major themes define the global economic landscape. First, the persistence of a high interest rate environment. Second, historically elevated levels of global debt. Third, shifting geopolitical balances. Global debt, both public and private, stands near record levels. For years, governments and corporations benefited from borrowing at extremely low interest rates. Now, refinancing that debt has become more expensive. This raises concerns about financial stability, particularly in highly leveraged sectors. At the same time, growth momentum is slowing. As monetary policy tightens, credit conditions become more restrictive. This limits investment and consumer spending. The economy of China is also expanding at a slower pace compared to previous decades. Weaker global demand, structural challenges in the real estate sector, and internal economic adjustments are affecting its growth trajectory. Considering that China has been a key driver of global expansion for the past 20 years, this slowdown carries global implications. These developments have revived discussions about the long-term role of the dollar in the international system. Some countries are exploring the use of local currencies in bilateral trade to reduce dependence on the dollar. However, in terms of liquidity, market depth, institutional trust, and financial infrastructure, the dollar remains dominant. The euro provides a regional alternative, yet political and fiscal integration within Europe has structural limits. China's currency is gaining visibility in global trade, but capital controls and transparency concerns continue to limit its full internationalization. As a result, the dollar-centered system remains intact, though underlying vulnerabilities have become more visible. Looking ahead, the trajectory of inflation will be the most critical variable. If inflation declines sustainably, central banks may gradually ease monetary policy. That could support risk assets and improve financial conditions. However, if inflation proves persistent, interest rates may remain elevated for longer than markets anticipate. Such a scenario would likely weigh on global growth. In conclusion, the world economy is not necessarily in a moment of collapse, but it is clearly in a period of recalibration. The era of ultra-cheap money has ended. The cost of capital has increased. Risk sensitivity in financial markets has intensified. The dollar reflects global liquidity and monetary policy direction. The euro signals regional resilience and structural constraints. Gold represents systemic trust and risk perception. The global economy has become a multi-layered structure shaped not only by central bank decisions, but also by investor psychology and geopolitical developments. The coming years will depend on how effectively inflation is managed, how resilient growth proves to be, and how confidence in financial institutions evolves. Uncertainty remains high. Yet periods of uncertainty are often when new balances are formed. At this moment, the global economy stands precisely at such a threshold.